Hello, everybody, and welcome to the Introduction to Accounting. This is part 18. This is creating journal entries from T accounts. So one of the things that I did not do is I didn't really talk about journal entries in the last 18 videos. The reason why is that when you make a journal entry, it comes from the T accounts, and I'll show you how that works. What we're going to do, though, is we're just going to go ahead and add a date and a description. Okay, before I say thank you for watching, let's go ahead and do this. So on January 1st, 2024, YYZ purchases equipment for $500,000. YYZ makes a 20% cash down payment and places the remaining balance owed on a note payable. Prepare the journal entry to record the transaction. So let's do this first, though, in T accounts. And why do we like to use T accounts? Assets have debit balances. They are increased with debits, decreased with credits. Liabilities and owner's equity typically have credit balances. They're going to be increased with credits, decreased with debits. Expenses are generally recorded with debits, and revenues are generally recorded with credits. So when we get to over here and we look at this, so YYZ is receiving equipment. And as long as that equipment is not a 7 Series BMW, we're going to be okay. So right over here, I'm going to debit equipment for $500,000. Okay. Now, if I paid $500,000 for the equipment, it says that I made a 20% cash down payment. So my down payment is going to be 20%. So what I'm going to do over here is I'm going to make that cash down payment for $100,000. So if I'm giving the owner of the equipment cash, I've got over here sitting with my assets, my cash is going to go down. So I'm going to show that as a credit. Okay, now, whenever we go through and have transactions, my total debits have to equal my total credits. So what do I need to do to balance? Well, I have total debits so far of 500,000. I have credits so far of 400. So the remaining amount I'm going to need as a credit is going to be 400,000. Now, what exactly is this? Well, I bought it with 20% down and I put the rest on a note payable. So I'm going to have to pay this amount back or I'm going to get my equipment repossessed. So right over here, this is going to be a notes payable. Okay, so we've recorded the transaction with T accounts. And the reason why I like this is that, again, by using T accounts, we're going to know exactly where different things go. I can share with you that in my 8+ years of teaching, actually it's now 9 years, I'm getting old. In my 9+ years of teaching financial accounting, managerial accounting, and even intermediate accounting, I'm busting out the T accounts constantly because this is going to be the best way to make visual sense of some of the problems. So right over here, now to do the journal entry, let's do this first. So we're going to go ahead and have account, debit, and credit. What I typically want to do is I want to list my debits first. So over here, I'm going to go ahead and show a debit to equipment for 500,000. Right? So if I kind of envision this journal entry with, I go down with a little T like this, I'm essentially going through and translating this over. I have credits of 100,000 for cash and 100,000 for a notes payable. Now, the one thing my students always get wrong is, at least the way that I test, is that the students will just list out these balances right underneath. That's not the way you want to do it. You want to indent the account description. And the reason is this credit is being indented. Now, in the real world, when you're using QuickBooks or, God, I love it, call it Slowbooks, if you're using a program like that, they probably are just going to show it flush. But over here, what I want you to do is, for right now, is we're going to go ahead and indent this from the equipment just so we know that we're crediting the accounts. Again, as we're learning accounting, you're going to be following some rules. And then as we get to later, be a little bit different. But for right now, this is all we've done. We've gone through and we've taken what we've written up here and we're just kind of summarizing it a little bit differently. So that's the first part. Now, With my journal entry, I need to give a little bit more of a flavor. So right over here, I'm going to have a date 1/1/24, and then I'm going to have a description. When you're recording a description, as long as I'm not saying that Tom Brady shouldn't have retired or that the Chargers are going to win the 2027 Super Bowl, well, I doubt it, or the Clippers will win an NBA championship, doubt it. And of course, now I'm going to be like when the Clippers win, you guys are going to be, oh, Tchaikovsky, like you were incorrect on your prediction. So right over here, I'm going to basically say to record purchase of equipment. Okay, that's all you need to say. Now, remember, why are these so important? Why do we want to make sure that our journal entries are so important? Because when we're at a company and we write out a journal entry, if I'm a staff accountant, who's going to be reviewing it? Well, my supervisor will be reviewing it, possibly the CFO. But then when the auditors come out, the external auditors, internal auditors, and potentially state tax authorities, they all might be looking at my work. So make sure you have that documentation done appropriately, but this is how you make a journal entry. Do the T accounts first, then put it into this format over here. Again, this kind of follows the T accounts. Cash is being credited, notes payable is being credited, so these amounts are indented, right? So you got this, you're going to learn how to do journal entries. So that's all it is. Not that exciting, but it's exciting for us, and I want to thank you. So please feel free to leave your questions below, and I appreciate you videos. I look forward to seeing you on the next video. Have a great one.